Hello and welcome. You're watching The Money Show, your one-stop destination for your personal finance queries. I'm Kavita Thakliyal, and today again we have got your Power Pack show where we'll be talking about interesting strategies, looking at the market volatility and fall, and how can you rejig or revamp your portfolio adopting these strategies, and how can you get closer to your financial goals with taking minimum risk will be discussed on the show ahead. But then we will also answer your portfolio queries. So just in case you want to send across your questions, you can do that on our WhatsApp number, which is 86579745571. You can also email us your queries on themoneyshow@etnow.tv. Alright, so let's begin the show, and today I have with me Shweta Rajani, Head Mutual Funds, Anand Rathi Wealth. Hi Shweta, good evening and welcome to the show. And so when we talk about strategies, it's very difficult to actually to believe that you'll be having a portfolio where there'll be so much of loss or red, especially for people who just invested 3 years back or maybe 2 years back. So for them to look at such a market and to, have the guts to keep investing, continue investing, even if it is their SIP, it is difficult to digest for them. And when you talk about having strategies where you can mitigate your risk and you can actually diversify your portfolio and secure those returns. It sounds unbelievable. But here, this is the show where we talk about basic rules of financial planning, basic personal finance that will always keep you safe and secure, especially times like these, where we are seeing heavy fall and a correction, which was again overdue. And although the way the market was earlier, where we saw an undertone bull run, which was temporary, this also is temporary. But when we talk about strategies, what do you think, can be the first thing that one should adopt, especially a mutual fund investor?
Absolutely. Good evening. Like you rightly pointed out that recency bias could hit in, and where you've not seen such a significant correction in the last few years, it can get an investor worried. But I would say the first and the foremost, or the most basic strategy that one has to adopt when investing in, even if it's a mutual fund, is to have the right asset allocation in place. One cannot have a portfolio which is a 100% equity mutual fund portfolio. Imagine a year where there is a 25% correction, your portfolio would be down from 100 to 75. But if you have the right asset mix, let's assume you had 80% equity, 20% debt in your portfolio, that 20% debt would still yield you around 7%. So compared to a 100% equity portfolio, you'd probably be down 20% rather than 25% down. So having the right asset mix becomes very critical. Even if you have a 10-year horizon, even if you have a 15-year horizon, you cannot have a 100% equity portfolio. What asset classes, should you therefore go in for? You have equity, debt, gold, real estate. But then when you make your choice, what you should keep in mind is costs, liquidity, taxation, and the return and risk ratio. So this, I would say, would be the thumb rule that you should have when you're looking at strategizing and how you can minimize your risk.
So, Shweta, now let's take scenarios, because we are talking about investors with different kind of investment horizons. We're talking about investors, who just have their goals coming up. We're talking about investors who have sufficient time for their financial goals. We're also talking about investors maybe who've just started investing 2 years back. So for all of them, their experience in markets would be different, okay? Although what you said is the basic rule: diversify across asset class. But when someone is new to equity, especially the new tranche of investors that came 2.5 years back, most of them just have a lot of equity because they were getting good returns. They just kept investing, and now the portfolio is totally, it has a larger chunk of equity as far as investment is concerned. So considering all these scenarios or all these type of investors, diversification across asset classes, across equity becomes the common rule. But when to strategize and how to strategize? What if someone doesn't have gold in their portfolio? Real estate, let's assume people have mostly, in physical form, and that is not something that you might just want to move around so quickly. So that kept aside, what should be the action plan in your portfolio right now?
Absolutely. Kavita, while you mentioned that last 2, 3 years, people who've been investing, they would not just be equity heavy. I'm sure there'd be mid and small cap heavy within that equity. But leaving that aside for the time being, see, how do you strategize? Let's assume the first thing of year therefore becomes goal setting. Decide your goal before you start investing at whatever age you're starting, but you should know for what is your investment horizon. Now, you could be someone who started 2 years back and you have a 20-year horizon. So you may be having an 70-80% equity portfolio, which is fine. During periods like this, take it as an opportunity, continue with your investments, and maintain your asset class. You could have a second category of investor who, let's say, has your goal, which is likely due in the next 1 year or 1.5 year or somewhere around that. Here it becomes very important that if you have your goal which is coming up and it cannot be postponed. Let's assume you have a child's marriage, and this goal cannot be postponed. What you have to ensure is whatever amount you need, a larger portion of that should be shifted into debt, so that any kind of a market volatility that you are witnessing right now does not impact your goal achievement. So 1 year before, what you need in terms of your goal amount should be shifted into debt. That's one strategy you should adopt. Second, I would say always have an emergency fund. Even if your goal is, let's say, 10 years away or 5 years away, ensure that at least 6 months of your living expenses are parked in something which is not market linked. That is another strategy that you should adopt at any given point of time. Third, you mentioned about having gold in the portfolio. So see here again, if I compare gold with equity and debt, then over a longer time period, gold could give you returns which are slightly more than debt. But from a risk standpoint, even they go through long periods of cycle, and their risk would be in between debt and equity. So if you want to have some gold allocation, because you may want to also consume gold at a later stage, maybe a 5-10% of gold, but primarily your portfolio should be constructed around equity and debt as a good combination to have.
Also, Shweta, let's also talk about investors now who just have mid cap and small cap in their portfolio. Now, how do you go light over there? Do you shift all your money in large cap? How do you rebalance your equity portfolio and maybe go large cap heavy? Just because we'll be seeing a lot of volatility and mid cap, small caps are, the froth. We were talking to a lot of experts and a lot of fund managers. 70 to 80% froth has already gotten cleared now, but there are few pockets where in mid cap, small caps valuations are still high, so there could be further more correction that we might see. Having said that, what should be the strategy to go heavy in large cap? Should we be going heavy on large cap? People are invested through active, passive also in large cap category, and the same scenario we are seeing in mid cap, small cap also. So how do you reduce that?
Sure. So, firstly, when we say that it's, a lot of the valuation is corrected, absolutely, given that you've seen almost a 15% correction in large caps and, 20 odd percent in mid and small, your valuation pretty much, I'd say, has come closer to what we would call as a reasonable valuation. Now, small cap as a segment, you know, it is a segment which at least has 250 odd companies, just the small cap 250. I'm not even getting to the micro cap index here. But within that 250 companies, you'll find something which is available to you at a 15p, something that's available to you at 100p. That is where it becomes very important that you give your money to the right set of fund managers who are able to identify where the good value is. So it's not that mid and small cap is a complete no-no, or you should completely shift out of your mid-small allocation or stop your SIPs in mid-small and shift to large. I don't think that is needed at this given point of time. A good combination of large, mid, small is what is needed at all times, and even in times like this. So let's say if you had gone overboard, maybe you had gone to 60-70% mid small, yes, that's needed, that needs a correction. So I'd say having a 40% mid small, 40 to 45% depending upon your risk appetite, that's still a good allocation to have in the portfolio. So if you are not there, then maybe you should shift out from your small cap funds, enter into large cap oriented categories, something like a pure large cap fund, a flexi cap fund, a dividend yield category fund, which have a high or a bias towards large cap, is something that one should consider at this point.